Hey there, everyone. Dave Keller here with Market Misbehavior, and this is our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, investors, traders, authors, educators, money managers, strategists, anyone that we think has a compelling story to tell. We love to ask them questions about their process, their outlook, the tools and techniques that they use to assess market conditions, some of their lessons learned through their successful careers in the financial industry. A great guest today, someone who I've known for a number of years and whose work I've followed and respected, Mary Ellen McGonagle. Mary Ellen is the founder and president of MEM Investment Research based in Southern California. I met Mary Ellen and got to know her when we both were started as contributors to StockCharts a number of years ago, and enjoyed so much and continue to enjoy collaborating with Mary Ellen anytime I can. I think of Mary Ellen as a classic stock picker. She has sort of a top-down process in terms of how she identifies investment ideas. And we'll hear her explain how she thinks about the macro environment, what she thinks about broad market conditions like the Fed and tariffs and earnings and all these other things, but also is fantastic at understanding individual stocks and stories. So she is a true William O'Neill disciple, which is not surprising when you learn that she spent a number of years working directly with Bill O'Neill, working with their institutional clients around the world and helping them apply the O'Neill methodology to their portfolios. Now she has pivoted to work more with institutional investors still, but also individual investors. We talked a lot about her process, just her method of evaluating market conditions, how she identifies new ideas, what sort of routines she uses, what really defines the O'Neill process, a very chart-oriented investment process, but that also respects other disciplines like macroeconomic factors and fundamental analysis and earnings and sector strength or weakness. So I really appreciated her giving some clarity on a type of investing that I find so many individuals could benefit from. You know, we talked about the broad market conditions in terms of the S&P 500, but we quickly pivoted to talk about AI, the impact of artificial intelligence on her work as a market strategist, as an investor, how she uses AI in her own process, which I thought was interesting, but also just the AI trade fueling the incredible run that we've had off the April lows here in 2025. Really liked her comments about stocks being overvalued, which Bill O'Neill would say often happens at this point in the cycle. Everything looks overvalued in a growth-led bull market versus overextended when stocks get a little too far up in their uptrend. And I really appreciated that conversation. Also managing risk and using things like moving averages to make sure that you stay in trades as long as possible. A wide-ranging discussion that touched on process, background, but also a current market perspective here in September of 2025. So please enjoy this conversation with Mary Ellen McGonagle of MEM Investment Research. Super excited to be sitting down here with Mary Ellen McGonagle. Mary Ellen is the founder and president of MEM Investment Research, coming to us from Southern California. Mary Ellen, great to see you again. How are you?
Good. Wonderful to see you again as well. Yeah.
In a raging bull market, I feel like there's plenty of reasons to smile. I have plenty to ask you in terms of the conditions here and what we're observing and all of that. So we're gonna get to all of those things and more. To
Super.
start off with, I've known you and followed your work for many years through our collaborations through StockCharts.com and other venues. But you've got a pretty unique background compared to others. Can you talk a little bit about your investing journey? Some of those formative moments that have gotten you to this point here in 2025.
You bet. Yeah. Well, I'm going to take you way back to the dark ages, the beginning of my career. And my first position, I worked at Goldman Sachs
Okay.
for on their trading desk.
Right.
And it was just so unexpected. It was part of I was filling in for someone. I was a temp on their trading desk, and the gal that I was substituting for had a back operation. So I was there for quite some time at
Okay.
Goldman Sachs. But the gal that sat next to me there, she doesn't realize, I don't believe, how influential she was. She said, this was on the sell side. She said, if I had to do it all over again, I would do the buy side where you're running money.
Yeah.
So my next position took me to a very large asset management firm, and I was an assistant portfolio manager there. And from there, I did go on to eventually run over 2 billion in assets. I ran the trading desk there, and that was super exciting. From there, I did move out to the West Coast and joined William O'Neill and Company, and that's as it relates to equities, that's where things got really exciting for me. I traveled the globe meeting with top fund managers and teaching them that O'Neill methodology and wonderful experience. And now more recently, my own investment research firm working with self-directed investors. And then I do also have some institutional investors as well.
So that experience, I mean, each one of these could be a whole like hour discussion about what you learned along the way, and we don't have time for all of that, unfortunately. But particularly working with William O'Neill, I mean, who's known as, I mean, one of the, I mean, just legendary educators. I mean, so many, so many have learned about stocks and how to analyze them from his work, and how to make money in stocks is still one of my first recommendations to people when they're just trying to get their feet under them. What is it? I mean, how would you summarize sort of the approach that William O'Neill popularized, or what sort of makes that a unique way to think about equities and investing?
Yeah, so it was all about charting. And when I did
Mm,
begin there in the 90s, I do recall meeting with some very heavy hitters, if I may, very
yeah.
famous investment managers. And in a sense, it felt like we had to, it was like, shh, hey, come over here. We're gonna, we'll meet in this closet. Charting was just not as widely, nowhere near as it is now, as widely as accepted as it
Yeah,
is now.
yeah.
But there was certainly an audience for it. And I worked very closely, as you know, with Fidelity. I believe you and
Mhm.
we realized after the fact that we met there.
That's right.
Yeah, I was with Bill O'Neill on his, on a visit. Fidelity was one of my clients, and
Yeah.
so it was a very interesting dawning of the chart moment, but it was super, the individuals we met with were just so open-minded and really saw a difference in their investing by utilizing these charts. And we would walk them through, here's what this is showing you. And a big part of the job there was they would provide us with a watch list. As you know, these
Mhm.
analysts and the PMs go out, they meet with management, and they have a watch list of these stocks where they know at some point in time the growth is just going to kick in, but they don't want to own the stock until that moment. So
Yeah.
I would have access to their watch list, keep an eye on it, and XYZ is beginning to break out. It looks poised to take off, and that was a big part of the position as well.
When you think about your career, which has been, I mean, a very successful one, Mary Ellen, in a number of different roles at different firms, can you maybe share an example of a challenging experience as an investor, sometime when the market surprised you in a negative way? One of those lessons you look back and think, wow, that's when I really learned how to get through a tough period as an investor. Anything come to mind?
Sure, I can think of a couple of examples. Certainly, the late '80s when we had that crash in the bond market.
Yeah.
And as I recall, I was at heading the trading desk, and it I believe was around the holidays. I'm only mentioning that because the desk was empty. It was me, and all of a sudden the markets just caved in,
Yeah.
and I Rockefeller Center. Okay, this is probably getting too in depth, but there were a bunch of traders that were having lunch, and I had to run downstairs and
Nice.
interrupt this beautiful Christmas lunch and say, "Guys, let's get back."
Time to get back to the
So,
desk.
yeah, I mean, it was before cell phones and everything.
Right.
Anyway, so that was pretty monumental, but other periods as well, I can recall being out on the weekends, and if something happened globally, I would
Mm.
just bite my fingernails waiting for Monday, like, "Oh, no, what are we going to experience?" So,
Yeah, waiting for the impact to be felt, right? So
mhm.
as you think about, I mean, with your firm now with MEM Investment Research, and again, before we kind of talk about some of the current observations that you're seeing, can you talk a little bit about your process? You strike me as someone that anytime I've spoken to you, you tend to just have charts and ideas readily available. So there's something
Mhm.
that happens before our discussion that allows you to surface those ideas. What's your process of kind of assessing conditions and then focusing on opportunities? What does that process look like?
Yeah, that's a great question, and of course, one of the first keys is my absolute love of the markets, of
Mm,
equities, of uncovering that winner, and I have no idea how. I was speaking to a friend once, and I said, did you ever read Nancy Drew growing up?" And she said, "Yes, I loved it." I said, "In hindsight, I think that book series, because I think I read every book 3 times, it really
mm,
prepared me for the markets, because you are using all these keys, "Okay, look at that, let's slot that. Where does that slot in as far as interest rates, government policy,
yeah,
uh, company, as far as their products being needed and wanted." I know that's a strange analogy, but as far as my process, it is, pretty much a top-down process, as far as taking a look at where we are relative to the economy. And of course, right now, inflation and interest rates are super critical. And then always on the lookout for that innovative new technology. And that's something that O'Neill was very, very big on. When you're
yeah,
looking at stocks, you want to make sure you are in a company that is presenting an existing, whether it is a technology, it could even be restaurants. When fast food restaurants first came into play, they are introducing a new way to present to you an existing product, but it's in a way that's innovative, that's going to capture a huge audience and then see growth. So all of those factors are taken into play, and yeah, it's very, very compelling.
so with that in mind, I mean, right, the equity indexes have had a pretty remarkable run off of the April lows. We have a chart of the S&P 500 up here, but just recently, here in the last week, we're recording this on Thursday, September 25th. This week, all of a sudden, we're starting to have a bit of a pullback, not unlike some of the pullbacks we've had through the summer. But what are your observations when you think about the broader market? I mean, from a high level, do you find more reasons to be confident and optimistic given the trends up to this point, or is it more cautionary given the extended run that we've experienced? Or what's your general take on the conditions here?
Yeah, so about a week plus ago, I did start to raise warning flags, and it had everything to do with the fact that the S&P and the Nasdaq both had an RSI that was in an overbought position. So
Yeah,
that's above 70, and in fact, the weekly chart as well. So when you see that type of activity, it by no means is an immediate uh, the concept that it will immediately pull back is does not hold water, but it certainly is saying, "Hey, let's put the brakes on a little bit here. We are in that overbought position." It's not something that happens terribly frequently. So when it does take place, you want to be a little more cautious. And then I do my MEM Edge twice weekly report. I have a Sunday very lengthy report, and then on Wednesdays I provide an updated. Here's what's on the move. Here's why. And
yeah,
yesterday I was advising to take profits. I mean, we've had well, Oklo last week was up 68%. We've had these names on my suggested holdings list. It's about 22 stocks, and they were all popping like up 20%. And then the next week up 18%. And we were, it was just this great run up. But then at some point in time, having so many years of experience, being through so many market cycles, you just have to know that feverish pitch will at some point level off at the very least.
how do you, I mean, when you think about the S&P and the Nasdaq, obviously again with the incredible run that it's had, and then we start to roll over, we're overbought going into this week, as you absolutely said, and on the weekly chart as well. I'm glad you mentioned multiple time frames kind of at work here. How do you differentiate between sort of that garden variety pullback like we saw in like July and August versus the kind of pullback where you really want to start to meaningfully change positioning? Are
Mhm.
there specific levels? Is there a specific drawdown? Or what kind of tools and techniques would you use to try to minimize, exposure during an extended pullback kind of phase?
It's certainly the go-to number 1 is going to be that chart. So
Yeah.
oftentimes when you see the again, I'm gonna circle back to that RSI on the daily,
Yep.
and when that RSI turns negative,
Mhm.
and you can marry that with a negative MACD crossover, it's just one of
Right.
those historical precedent type of actions that do often precede further deterioration, but for me, that real line in the sand is gonna be that 50-day moving average, and
Yeah.
once we break below that, if we do so on heavy volume, that's another statistical event that when it takes place, you are well served to head for the exits. Now, if you are longer term in your outlook, there are a couple of names with my MEM Edge report that we sat through that bear market, Palantir being one of them. And
Yeah.
if you were to pull up that weekly chart, you'll see that it remained bullish. So, but it will have everything to do with your investment horizon. If you are shorter term, you don't have an appetite for that drawdown, you will want to use those other daily chart indicators.
The 50-day or the 10-week moving average, that comes up a lot in the William O'Neill methodology, right? As sort of a
Exactly.
line in
Yeah.
the sand, right, to think about during an uptrend?
The line in the sand, so to speak.
Yeah.
Absolutely. And then always paying attention to that volume. We're
Mm.
still in a phase, a lot of people, particularly for me, having worked with self-directed investors, you can lose sight of the impact of those institutions, but it's something that I looked up, I believe, last week, and there's still 80% of the volume that you are viewing on your chart, particularly for these bigger names, are in fact, institutional money at play.
Yeah. Yeah, there's a lot of zeros and a lot of accounts, I would say, right, being rotated between some of these different charts. So, talk to us a little bit about some of the leadership trends that we've observed. You mentioned Palantir, obviously, which has had a pretty incredible run here
Yeah,
in
we picked
recent,
that up in '24
not bad, right? And
and
pretty
stayed
pretty
with it.
incredible
Yeah, I'm
gains.
up. Oh, well.
How talk to me a little bit about some of the, Magnificent Seven stocks, right? The Nvidia, the AI trade.
Mhm.
While the trends have been remarkably strong, undeniably so, there's no shortage of people noticing the valuations, which are, stretched to say the least, and
You bet.
arguably quite expensive. How do you balance the opportunity versus the valuation and the runs that some of these names have already had?
When you mention valuation, I will tell you that that is one thing with my 15 years with William O'Neill, and we would have weekly meetings with Bill O'Neill there, and there were about 8 to 10 of us that were in the room with him. And we would oftentimes, in fact, twice a week, and we would a lot of times the conversation, or not a lot, but a few times it would circle around to that concept of valuation. And one thing that Bill O'Neill was adamant about was the fact that it in these faster moving, high demand growth stocks, you can't pay attention to that valuation, and he would equate
Yeah.
it to the fact this is years ago when that concept of these athletes being paid what was viewed as astronomical amounts of money, and he would say that is warranted. They're in high demand, and that is a very similar analogy to the markets. So you can't get bogged down by that concept of multiple when you are looking at these big, faster moving names.
That is such a great analogy right there, the
Mhm.
overvalued stocks with, arguably overpaid athletes, but I'm not sure when that conversation actually occurred, but those
The
numbers have gone
90s.
up aggressively since the '90s, right? I mean, you look
Yeah.
at the numbers now, it's staggering, right? Even by modern standards. Talk to me a little bit. I mean, obviously the general story of 2025, I would say among a couple has been the dominance of AI. How do you think about the strength in some of those charts like Nvidia and Palantir and others that have had really good runs versus other areas of the market? And at what point are you seeing signs of a rotation where there's emerging strength elsewhere, and where do you see those kind of moves?
Yeah, so I believe you and I both we appeared at a money show last, about a year ago,
Yeah. Yeah,
right?
that's right.
And at that time, I did a presentation there, and it was all about AI and how to
Mm.
participate. And I will tell you, it was in the dawn, the early ages of AI, and the room was packed.
Yeah.
And I recall walking through the picks and shovels. We're in the first stage. Here's the first part of that stage is you're going to need the enabling technologies, and then talking about the broadening out beyond that.
Yeah.
And so as we move into Q4 of this year, we're actually at a new phase now. We're exiting from that. We're in a period where AI is very, very actively being utilized. So
Yeah.
with that, we're seeing more of an interest in robotics in those areas where the applications can really take effect.
Hmm.
So it doesn't mean it's over for the initiators and those that, but it's going to be all about innovation and staying on top. And so Oracle's earnings were a huge wake-up call relative to that. And with Oracle, they not just their earnings, just their announcement going into 2030 as far as the newer, they have newer technology and they're going to be more agile
Hmm.
than these M7 names that were earlier to the game. They put all of their eggs into the GPU basket, and they are not going to be quite as nimble. That's something I talked about in my report after Oracle came out with numbers. And in particular, there was a sense that among those M7s, Amazon was going to be potentially the most negatively impacted as far as their AWS cloud division beginning to see a little less traction, and then their inability to pivot. So it's really paying attention to those nuances as opposed to very blindly just saying AI and jumping into everything. And likewise with Palantir, when I think back at that
Hmm.
company in 24 relative to where they are now, and now they are expanding globally. They've just signed a huge contract with the UK military, with their military um, department.
Hmm.
So it's you really do, and you need to again. There's going to be nuances. There's going to be turns off the freeway that you're going to want to be aware of. And I will tell you, my MEM Edge report. I'm all about that.
Yeah, for sure.
Yeah.
And arguably, I think that's going to be the one of the biggest challenges you and I and other investors need to be focused on is just the rotation from some of these names. As you said, right? I mean, the world's very different from a year ago. I mean, 3 months ago, I feel like AI it's how quickly it's evolving. I'm curious personally how has AI impacted what you do in terms of analyzing the markets or anything? And do you see that impacting what you do as an investor going forward, and how?
That's a great question, and I can really drill it and take you down to as far as my report. It's not a dramatic difference, but it's allowed me to kind of let go of some of the more expensive research,
Yeah.
and I can, in fact, access information more readily, which I
Mhm.
have been a big believer since if we go back to the markets during the period where I can recall running money and we would get a phone call from Solomon Brothers. Do you remember them?
Oh, yeah.
And get a hint that this big bond buyer's in, and we were getting this information funneled, uh, and the self-directed investor had no way of getting to that. And thankfully now we with the playing field over the years has been leveled, and it just continues to be the case. So I think that's great news.
It's so funny. I feel like when something like artificial intelligence comes out, and we've seen this with a number of things, with quantitative investing, with machine learning, all these other sort of steps that happen before that. I remember being asked in some presentation, like, is that the end of analysts? Is that the end of technical research? Is that
Mhm.
and I would always be like, it's going to change what we do and hopefully makes what we do easier. And what I found, I mean, for me with artificial intelligence, things like ChatGPT, it's helping me do things I didn't like doing in the first place, right? It's making those annoying things that I really didn't enjoy doing. It's those
Right.
routine things, like it's able to do it better than I could. Like that's great. And I can think about actually things that a human being can do, which is be creative and think about relationships. So
Yeah.
we're on the same page with that, I would say. So Remarkable returns in AI stocks aside, let's talk about another area of the market that has been remarkably strong in 2025 in the commodity space, particularly precious metals. Gold, silver ETFs doing quite well. Now you're
Mhm.
seeing, I mean, just an exponential rise in Newmont mining, Kinross, a lot of the gold miners. Do you think that trade has been experienced and now done? Do you see reasons to be
Yeah,
optimistic
it's
there?
interesting.
How do you think at this point
Every
on the
time
trend?
you think it's done, it
Keeps going,
took
right?
another leg up. In fact, oh, okay, yeah, I didn't wind up doing it, but I suggested it as a title for one of my, MEM Ed shows, "Gold Stocks to the Moon." That was a few months ago. But the point is, among those factors when looking at gold stocks, you are gonna wanna keep an eye on interest rates, and
Yeah.
interestingly, yields have been cropping up. They're up again today. So
Yep.
when you see, interest rates creeping up, you are gonna see a pullback generally in gold stocks, and, not sure if we're yeah. So that's gonna be another component to pay attention to, but in addition to gold, if you pull up URA and take a look at those rare metals,
Yeah.
that's that AI play, within those metals, and you can see and then also steel stocks have been on the move, a lot of that tariff related.
Sure.
So there are certainly other factors at play in, these metals.
I'm glad you brought up uranium. Another
Mhm.
guest recently talked about a rare earth ETF that was interesting to look at as well. You're seeing a nice, uh, uh,
Parabolic, yeah.
yeah, parabolic rise in a lot of those areas. When something, I mean, with any of these, like with URA or something like that, I know when we have one of these big moves, people often get pretty nervous about chasing those gains. How do what sort of is there a specific tool or technique that you would use to say, wow, this is still worth getting into versus I may need to hold off a little bit? Is it going back to overbought and oversold conditions, or how would you sort of, with some of these charts that feel like they've already had an incredible run? Like what either compels you to take action or tells you to hold off a little bit? Anything in particular?
For me, it's gonna be really paying very close attention to the leadership names in a given group, and
Yeah.
a lot of my work is going to be thematic. I begin
Mm,
with a view of the sectors and then drill down to industry groups.
yeah.
So when we, for instance, were looking at, well, among these energy names, BE was one of the first to really pull back, and there was a Jefferies, an analyst came out and had a very benign statement, but it was a good excuse for that big run up
Yeah.
to see a pullback, and then from there, OKLO, and so you want to really have your arms around where are and by leadership, oftentimes it's gonna be those names that are first out of the gate and that do run, quite quickly. So keeping an eye on the price action there. Now, when looking at AI stocks, we are seeing a pullback, but interestingly, the quantum stocks, that's that next upcoming phase for AI. We're
Mm,
not quite there technologically, so there is still a little bit of more risk, but it is viewed as that next wave. And in noting today, for instance, QS and RGTI and some of those names are retaining their uptrends and seeing a little bit of buying. So
mm,
it's that kind of auxiliary, keep your eye on because it's not some of those names are not quite as extended. You could view them as being later to the game and keep an eye on the price action there. Is it widespread as far as deterioration, selling, profit taking, and so on? We are about 3 weeks out from earnings season, so and then September is renowned for being a difficult month.
yeah.
So keep that in mind as well, the sense that we're in this void period where we don't have these big companies telling us about how great their growth looks. We are, in a bit of a vacuum from that regard. So, keep that in mind as well.
I think this might be the most poorly outlined interview ever because I'm just sort of following interesting things you're saying and going on, but I hope everyone's following along with us because I want to go back to a couple macro points here that you sort of alluded to. One is interest rates. You mentioned the interest rate environment, how that can impact gold stocks. Certainly, other groups like home builders, right, are
Technology.
technologies here all can be interest rate sensitive. How do you think about? I mean, obviously, we had the first rate cut in quite some time. Just this month, we've
Mhm.
got two other, Fed meetings where they're expecting a 25 basis point cut. Looks market pricing in kind of similar moves at the beginning of the first quarter. How does that sort of expectation or that sort of, I guess, potential future move? What does that do? How does that inform your analysis today, or would that impact your positioning in some way, or is it more of a
No.
let's wait and see how it impacts the charts kind of approach?
It's all about what are the charts telling you. So in
Yeah,
fact, I did write about this in my weekly report on Sunday. The fact that even though the Federal Reserve did announce a rate cut and made steps toward two more rate cuts, and then even into next year, last week, interest rates ended the week higher. And
yeah,
that is the bond market saying, hey, we think inflation's still sticky. Employment numbers, we could see economic decline. We're not believers.
yeah,
And so that was another red flag that I did wave, in essence, stating that if we continue to see interest rates, and I did include a chart in the report that showed the interest rate and relative to, in particular, technology and
right.
industry. And so if we continue to see these interest rates climb, at some point in time, you are going to see negative impact. And so you mentioned home builders. Home builders actually, they did have that head fake, and at first I was like, oh, and then the more I dug in, I thought there's their sales are not there.
Yeah,
Even, interest rates, no matter how far, the growth just wasn't there. So you look at a Lennar, LEN,
yeah.
and these other companies that are not producing results. So we're not seeing that direct relationship relative to interest rates. So I'm looking elsewhere for that interest rate play, and we can see some of these bank stocks are coming in fairly well, certainly the bigger names, and then other interest rate sensitive areas that are more definitively responding.
Final question, Mary Ellen. I mean, think about the number of macro headwinds that should have held the market back. Or certainly there was a lot of expectation for that. Geopolitical risk with a number of conflicts happening around the world, which don't seem to be going away. If anything, seem to be escalating. The impact of tariffs, which has been arguably non-existent in terms of actually impacting companies, markets are robust. So given the run that we've had, I mean, what do you see as the biggest risk that hasn't been priced in that could be the issue that finally brings this bull market to its knees? Is there one that stands out to you, or what would we look for? What's that next shoe that we haven't figured out that's going to drop on us?
Yeah, so if we look at the advance in AI related stocks,
Yeah,
it's been real. There have been, this is something else I wrote about, there have been comparisons to the internet bubble. And the
yeah,
big difference now relative to 99, when that internet, Qualcomm, and those any other number of names, the earnings were not there at that time. And so we did eventually see the collapse. But at this point in time, there are actual earnings that are being derived from this move into AI, whether it's the M7 names spending insanely to capitalize and get their systems up and running.
yeah,
But there are real numbers that are backing the move into AI. So there's a little bit of comfort there. What would, in fact, the other shoe to drop would be, for instance, if we move in, I mentioned in about 3 weeks, we are going to have the beginnings of another earnings season. But if we
yeah.
begin to see a deterioration, a leveling off of those earnings that are AI derived, that certainly would be a big stop sign.
I feel like there's plenty of money to be made on the left side of bubbles, and it has a lot of those characteristics, but still, I mean, if the charts are good, the charts are good, I would say. I
Mhm.
appreciate those insights as always. Mary Ellen, you and I met years ago when we both became contributors at StockCharts.com around the same time. I know you have a product coming out with them very, very soon. What can you tell us about it?
You bet. Super excited about this. I have a 5 5-part course, and it's titled Mastering the Art of Uncovering a Winning Stock. And it takes you through each of the steps as far as knowing those characteristics that are common among these big winners. This is all about Bill O'Neill's work for many, many years. It's something that's very indoctrinated in my work. And at the end of this 5-part course, there is a list. It's taking that big market, thousands, 10,000 names, and funneling it down to a very usable list. Not just usable, it's putting you in front of these names that go on to far outpace the broader markets. So that course is going to be introduced in about a week from StockCharts.com.
That's fantastic, Mary Ellen. I've learned a ton from conversations with you over the years. I think you have a lot to offer investors, and I would certainly encourage them to check that out when it's available. Where can we point people today to learn more about you and your work?
You bet. So MEM Investment Research is my website, and it's still a little bit under construction, but certainly workable. From there, you can reach out any questions anyone might have, and of course, take a look at that twice weekly MEM Edge report. There's a 2-week free trial for those interested.
Mary Ellen, you and I always like to remind people, you very generously met me for lunch years and years ago. When I learned we were both going to be, contributors, I reached out to you, and you met up with me in Southern California, and
Yeah,
enjoyed that. And it's from that moment on, have enjoyed overlapping with you anytime. So thanks so much for coming on the
likewise.
show. I hope we can
Thanks for
continue the
having me, Dave.
conversation.
Yeah,
All right,
super.
take
Hope to
care.
see you soon.
That was a great conversation with Mary Ellen McGonagle, and again, having an opportunity to sit down with someone like her, who had direct time, who was able to be mentored by someone like Bill O'Neill, who I would argue one of the great educators in the history of investing, is a rare treat. And then being able to build on that mentorship, and being able to work with successful investors around the world, money managers and others. She just brings a wealth of experience to our discussion. Really appreciated her characterizing of O'Neill's methodology about how to think about valuations in a growth-led bull market. As Mary Ellen told us, right, in a growth-led bull market, you really shouldn't worry too much about valuations. And at any point, at least in my career, when there's been that growth-led bull market, someone somewhere, if not a whole chorus of naysayers, will start complaining about valuations and tell you all the way up, stocks are overvalued. You shouldn't be buying stocks. And that happens all along the way during a sustained bull market phase. As Mary Ellen explained, according to the O'Neill methodology, right, valuations just aren't that helpful, because it's all driven by optimism. It's driven by future growth that really hasn't just materialized yet. What I would say is, instead of avoiding the markets when a growth-led bull market is firing on all cylinders, you just want to be looking for signs of a change of character. Look for signs that all that euphoria is starting to dissipate, where we're starting to get investors rotating from risk on to risk off. And that's why I asked Mary Ellen toward the end what sort of red flags she'd be looking for. And I would say similar things. I look at credit spreads. I'm looking at volatility. I'm looking for a rotation to defensive sectors. And none of those are really giving me big warning signs just yet. But it's important to not become complacent in a bull market phase like this. As a number of my recent guests have pointed out, bull markets are great, but they can also really get you at the end when a bull market is no longer in force, if you ignore the signs that the character of the market is changing. Thanks again to Mary Ellen McGonagle. Great take, great examples, great charts as always. And I really appreciated particularly her comments about where she's seeing some potential opportunities here in September of 2025 and beyond. By the way, if you want to learn more about some of the tools and techniques that we discussed in today's episodes, how to use technical analysis tools to identify opportunities to stick with winning trends and to recognize changes of character on the charts, our Market Misbehavior Premium memberships may be a great way for you to upgrade your own investment process right about now. 3 great benefits to the premium membership. First off, you'll have access to all of our virtual courses like Flight School Behavioral Investing. You'll learn all about behavioral finance, what happens between our ears as investors, and technical analysis, a practical set of tools and techniques to help us better understand the world around us. You will also have access to all of our members-only reports, like our weekly flight plan. That's our main investment report. We put it out every weekend. We look back at the week that just happened, what was new, what was different. We look forward at the week to come. What levels, patterns, signals are we watching out for? Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our member community. This is where a small but mighty group of like-minded investors encourage one another, ask questions, and share ideas. I'm in there every day answering questions, sharing charts, sharing some encouraging thoughts about the market environment, but it is a great group and a lot of fun. I hope you will consider joining us. For more information on our premium memberships, go to marketmisbehavior.com/premium. And don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. By the way, we're always looking for great guests for our Market Misbehavior podcast. Wherever you're listening to this or watching this, drop a comment with any suggestions of who we should approach to get on the show, and we'll take a look. For Market Misbehavior, I'm Dave Keller. Have a great one, and remember, it's always a good time to own good charts.